The US Volatility Index, also called the VIX or the Fear Index, has spiked to October highs. That's because of worries that the Fed will delay interest rate cuts. And now some are pricing in the possibility of no rate reductions this year. Our guest says we have, in fact, hit a sweet spot to invest. We're joined by Barry Martin, lead portfolio manager of the Morningstar 5-star Shelton Equity Income Fund. Thanks very much for coming on the show. You're going to talk about covered call writing strategies, among other things. And of course, volatility is your friend when you're writing options, isn't it?
That's right. So if you look at volatility and the pricing of options, there's basically 5 factors. And the number one factor, the most important one, is volatility. So as volatility expands, the options are actually worth more. So for an option that for a single strike price that you would have sold maybe a month ago or 2 months ago, when volatility was lower is worth maybe $1 or even $2 more today for that same strike price. So it really has an effect on options and what options to sell. And you can take basically more off the table for a similar strike price, or even hedge your portfolio a little bit more than you did before.
And your fund uses covered call strategies?
Exactly. What we do on a big basis is basically we're generating additional cash returns by monetizing volatility, and we do that by selling covered calls. So we have roughly about 100 positions, with each of them having calls written against the underlying equity. So it's really attractive to clients that are looking for income. Right now, we attempt to generate anywhere between 6 to 9%. Morningstar has us a little bit north of 8%. Or someone that's looking for a smoother ride to the end. Basically, our standard deviation's about 25% to 30% lower than the S&P. So if you're looking for a smoother ride or income, covered option writing might make some sense to you.
And your assets, according to what I can see here, about $650 million US.
Correct. So, this strategy has actually gotten really popular in the last couple of years. According to Morningstar, it's actually had the second most inflows of any category the last 2 years. It basically went from like $7 billion to about $70 billion. You see a lot of the big names, the Goldman Sachs, Blackstone, or BlackRock have come in with their own type of funds. But we've been doing this for 15 years here, and I've been actually doing covered option writing for about 25 years. So it's nice to see the market come our way and see how, the attractive returns. And it's really a nice alternative to generate income. And, people are always looking for finding different ways to generate income.
The problem, of course, I know you're sick of hearing this, is that if stocks go up sharply, you can get them called away, can't you?
Yeah, exactly. So one way to look at it is basically, taking some money off the table. And so you can do that by selling certain strikes. Also, a lot of people like to exit at a certain level. So we like to look at it as that you get paid to exit at certain levels. So right now we've obviously had some appreciation in the market over the last year and a half. We had a little pullback here, but if one still wants to own some equities, but feel that we're a little long in a tooth and a rally, what you could do is you could sell away that upside and generate those premiums. And if the market doesn't hit that target price where you sold, you get to keep that premiums and you can do it again. But obviously, if you're bullish on the stock market and you're looking for dramatic appreciation, covered call writing isn't the right fit. So it's really like putting the ball in your court and what you believe the market's going to be. This year's obviously been quite choppy. I mean, obviously, we have what's going on in the Middle East. We have, as you mentioned earlier, you have inflation worries. And I don't know if you heard, we also have an election coming up. So there's a lot of unknowns that are out there. And if you don't believe the market's going to take off, generate anywhere between probably north of 10% is when you start to underperform, then covered call writing might make a lot of sense.
I know this is a broad philosophical question, but often isn't it better to simply just own stocks and not have any frills or overlays or anything? Not to diminish what you're doing, you're obviously meeting a need, but sometimes isn't just plain vanilla owning of stocks over the long term the best way to go?
Well, it depends. It depends on what the market does. It depends on where you are on your investment profile. I think if you're younger, I do believe that being more long and being more risk on makes appropriate sense. But if you're closer to retirement or in retirement, then these type of strategies make sense. Typically you have the 60-40 portfolio, 60% equities, 40% fixed income. We're starting to see people take a slice of the pie of that percentage, maybe 10% of equity exposure and 10% of fixed income, and creating a new asset class. And that's why these strategies have become so popular, because if you just look at the return pattern, it doesn't necessarily return like equities and doesn't necessarily return like fixed income. It has a different return pattern. So when you add this different return pattern to a client's overall portfolio, you've reduced their risk. Mm-hmm. So I'm a big believer in just depending on what you want out of the market. So when I was 25 years old, I was pretty gas the metal long. But as I approach my 50s, I've started to move over where there's almost only so much I can stomach.